Hi guys, this is Yishai Breslauer, the CRE SharkEye show, where we discuss commercial real estate on a high level, a beginner level, every level that everyone who's excited about this field should and be here listening to this. And today's show is really awesome and unique. Every show is awesome and unique, but today we have Randy Blankstein, who is he's a veteran in commercial real estate. He's a veteran of net leases, and you want to hear him. You want to hear what's going on there. You want to hear how to do it. You want to hear the front end of net leases from a guy who's doing it for no less than 30 years. Okay, so without further ado, I'm going to bring in Randy Blankstein. Thank you for being here. I really appreciate for you to be a part of this show. Our honor. How are you?
Good. Thanks for having me. Excited to be on SharkEye and offer what I can to the listeners. From a veteran in 30 years, you make me seem like an old man, but I'll accept it as wisdom at this point.
Okay, that's good. That's a positive thing. So let me ask you this. First of all, before we start, and there's a lot to talk about. We're going to discuss a lot of stuff today, okay? But, if you could just tell everybody on the surface just what you do, very short and very briefly. We're going to dig in later, what you do, and then we're going to hear how you get into it and how you started up, going all the way back, if you remember anything. Let's do this.
I'll try to remember back in the day, but
yeah, go ahead.
Quickly, and we'll go through the whole story later, but I'll just give you the quick summary, which is, after I graduated college, went to work in a commercial real estate firm and did kind of tenant rep and a few other things, and it kind of led me into this net lease world that it existed in the first place. So after doing it for a few years at a larger firm, which has now been bought by JLL, in 1997, started my own company called the Boulder Group, which is a boutique investment real estate service company that specializes in, single tenant net lease investment sales. So that is really, the investment sale of properties like Walgreens, Home Depot, Chick-fil-A, Starbucks, McDonald's. That's kind of what we do on a day-to-day basis. That's what we've always done, and that's all we do. Meaning we don't do leasing, we don't do development, we don't do property management. We just focus on single tenant net lease investment sales. And that's kind of been, my whole career at this point.
It's amazing. You know what? I heard from a firm, a guy I'm pretty close to, and they have like a big fund that they do retail. That's what they do. And I remember I once discussed with him, how about going with me with something else? And I offered him something else. He said to me, Yishai, listen, retail is our bread and butter, and that's all we eat. That's what he said. So I hear you when you say that's all I do, net leases. So that makes a lot of sense. And that's how you get a pro. You get focused on something. Tell me something. So, okay, you got into this field. You got into net leases. Take us a little bit into your business. What do you guys really do there on a day-to-day basis? Who are your clients? Who wants to buy net leases? Tell me a little bit.
Sure. So, in basic terms, we help buyers and sellers of these single tenant net lease properties, either acquire them or dispose of them. So on the disposition side, our clients are typically, probably not the coming year because there hasn't been a lot of new development in the last year, but typically, a lot of new developers do programmatic ventures with, certain clients such as, Chick-fil-A, McDonald's, Starbucks, etc., Dollar General, anybody who's expanding, and they, typically as part of their business model, sell the property upon completion. So there's always a portion of the market which is development based. Again, it's going to be lesser this coming year because not a lot of new development in 2020. Most of our clients though are kind of high net worth investors or family offices who buy these properties. A lot of them in 1031 exchanges, which is a tax law that lets you buy and sell a property without paying the capital gains at the time. It defers it down the road. So that's our bread and butter type of clients. But we clearly have, besides for developers, besides for the high net worth group, institutional buyers and sellers. So, there's a lot of REITs in the space. There's some insurance companies, and there's some other kind of, hedge funds and other people in the space that are a part of it. So again, we're more focused on the individual investor buyer type of thing than developers or REITs. And that just happens to be, the private buyer tends to be the largest share of the market, at least for now. again, on the buy side of it, which is a lesser part of our business, the representation of the selling the property is the fundamental part of it. On the buy side is a lot of people in 1031 exchanges selling multifamily properties, getting a little bit older in age and looking for kind of passive income as they head towards retirement. So they were active landlords in some major metro. They own some multifamily buildings, decided it's time to retire, and are tired of the active management part of it, want to downscale their small business or company that they own, and buy these property, just collect the checks every month and kind of use that as their retirement income. That's a typical scenario that we have.
So okay, so we have a lot of people always that listen that are savvy, and they do that, and they're already looking for those properties, and they know what the benefit of those properties. They know what it is, and they want to get to it. But those people who don't know that yet, they're asking yourself, what is really the net lease?
The reason they're so popular is because unlike traditional real estate, you have to deal with vacancies and lease up and constant tenant rollover and other things if you own a strip center or other active management property, multifamily. Typically net lease are, for the most part, freestanding buildings, a lot of investment grade tenants, and a lot of long-term leases. The net lease part is that the tenant's now paying, taxes, CAM, and insurance. Those are all tenant responsibilities for the most part. There's some leases that are double net where landlord has roof and structure responsibility, but for the most part, they're triple net leases. So there's really they're more of a financial investment than a real estate investment, because there's no active part that the landlord has to do on a daily basis. There's a roof problem, the tenant fixes it. There's an insurance issue, again, on the tenant, and the tax bill goes directly to the tenant. So as a landlord, you're really just a financial investor in the property. You're not an active manager of the property. And that's what the particular appeal is, especially to the older set who's looking for retirement and isn't looking for a lot of active calls
Right.
and other responsibilities to do. So it fits well with retirement. It fits well with kind of passive investors, and it even fits well with newer investors because you can walk into be in the real estate field without having to do all the responsibilities, without having to hire management companies, without having to create your own company. So again, it's kind of the safest and easiest way to get into commercial real estate field. The negative is obviously it's less higher return than a value add or opportunistic thing. Clearly, if you buy a piece of land and you develop it and you get a tenant there, clearly there's much greater financial rewards to do something like this. This is more about conservative. This is more about protecting your money. This is the bond market equivalent of the equity market.
Right.
It's your safe, conservative cash flow, and value add and opportunistic is more stocks that has greater upside but greater downside. So this is the conservative part of the commercial real estate world. But I think it's different between a net lease and a ground lease.
Yes.
So the difference is, and I'll bring in leasehold as well, which is, in a leasehold, you own the building, but not the land. So you get the cash flow, you can get 100% depreciation, but at the end of the day, so you get a higher yield as well. But ultimately, the building reverts back to the ground lease owner eventually down the road. In a fee simple ownership, which is the most common, you own the building and the land, which is more traditional real estate ownership. And then in ground leases, you own the ground under the building. The tenant pays rent to you, and at the end of their lease term, which could be 20 years and with options maybe 60 years, the building reverts to you as well. Clearly, it's the safest because you have the lowest basis, but the negative obviously is it offers the least return, and also there's no depreciation on the ground lease because you're pretty much on land. The only direct relationship we have with the tenants, because again, these are usually the tenant's already occupying or the development's built it for them, and there's a lease in place, so we don't deal a lot with the tenant side. Other than in the sale leaseback market, where a lot of smaller franchisees and some larger companies, do sale leasebacks of their properties, and obviously when we offer them, they do, new terms, 20-year deals, and they're trying to, get the real estate off of their books and just focus on the brand, which is what Wall Street rewards at the moment for, their company fundamentals. People think that if you're buying, a certain company, be it Home Depot or what have you, that you want to buy that company. You don't want to be buying their real estate. You should be focused on their brand and their stores and expanding, not on their real estate portfolio. So, a lot of retailers specifically have, moved real estate off of their balance sheet via sale leaseback.
Right. Let me go back a little bit. People who are looking into getting into it, they don't know much about it. What are the steps they have to look at if you could guide those people?
how do you evaluate net lease when you're getting into it for the first time, and kind of what are the steps? So look, I think obviously the first part is you evaluate what kind of equity you have to invest. And typically people leverage these properties in the 60 to 65% range. So, if you have $300,000, you're probably looking at a $900,000 or $1 million property. So once you kind of get your aspects of that involved, you kind of target a certain return, whether it be 6%, 6.5%, how much leverage you want to use, and kind of, how long a lease term you want to do, which is, most people want 10 years, some people want 15-year terms. Clearly you can buy shorter terms, but shorter terms offer higher reward. But again, shorter terms have rollover risk, and a lot of people don't want to get into this business immediately and have rollover risk. So, you kind of want your first property to be, on the smaller side, typically investment grade, typically a longer term lease. A lot of people who are starting out look at kind of smaller properties, which is Dollar General, Family Dollar, Sherwin-Williams, to kind of get into the market. And they're looking for, good traffic counts. They're looking for, growth areas that they can get into, and they're looking for locations where they think the store either has proven well or does proven well, and has a good trade area and lack of competition, and is infill to some extent that, the tenant can't go and easily replace the site somewhere else down the street at the end of the lease term, and that, will perform well over time, and hopefully your tenant renews, which is the goal of this, to invest in these in the first place. A lot of people are getting these into, the non-renewal scenario, which is very uncommon, but does happen occasionally, and you have to still look at real estate values. But your first investment, I think, a lot of people go to dollar stores as a way to get into this market.
I'm going to give you a scenario. You're going to tell me what you think. I want to buy a property, 5-year lease. What do I have to look at?
Look, on a 5-year lease, clearly one thing you're going to look at is, two things right off of the bat, which is, store sales. You want to make sure your store sales ratio, that it's, doing average to better than the company average, and that the rent is at or below market. Because clearly you want a protection from, one is renewal probability. Obviously, if strong store sales give you a high renewal probability, and low to mid market rent gives you a better negotiating position for the renewal if they don't exercise their option, or B, for replacement tenants. So those are kind of two things you look at off the bat. Obviously, like I said, you need to go back to real estate fundamentals, which is, traffic counts, vacancy, demographic growth, type of building, and then, roof age, parking lot age, things of that nature. When you get to a shorter term, you want to understand what your residual position is in the event of a tenant non-renewal scenario.
Tell us a little bit about what is the typical net lease tenant that you guys are going to deal with, and the type of credit. What are the pros, the cons? Can you walk through this a little bit?
Yeah, so the most in-demand tenants today are obviously the essential tenants that have, endured during COVID, which is grocery stores, drug stores, dollar stores, and anything deemed essential. Convenience, gas stores, etc. have, fared well during COVID, and that's clearly, they're essential. A lot of them are investment grade. That's clearly where kind of the demand is. Grocery stores are obviously larger price points, from $6 to $15 million primarily. Again, dollar stores are in the $1 to $2 million range. Drug stores are kind of the $4 to $8 million range, and convenience stores can be from $2 to $5 million for the most part. And each one kind of has different risk reward profile. Dollar stores, again, investment grade, 15-year leases. People like them a lot. Good price points, $1 million to $2 million. The negative is some of them are in tertiary markets, which causes concern for reuse down the road.
Right.
Of course, gas stations, C-stores, people like their hard corners, signalized intersections, very essential. But, some people think down the road electric vehicles are going to gain a greater market share. And, maybe 20 years from now, there could be a different business model between oil and electric vehicles. So, that's a factor that overlays the market on a longer term perspective. I don't think it changes things in the short to medium term, but longer term, electric vehicles are certainly on the table. Pharmacies and drugstores clearly have done very well during the pandemic. But again, I think the concern is, look, Amazon's getting into that market, and while the front of the house is where they kind of make their money, not necessarily prescriptions. Prescriptions is what drives the traffic.
Right.
The concern is what's their right footprint moving forward, meaning should they have an ATM in there? Should they partner with someone else? What's the selection of food versus, non-prescription drugs? So again, I think there's, business model concerns regarding, kind of changing floor prints in the future. But, people like them. A lot of them are hard corners. A lot of them are signalized intersections. And, a lot of people use these as convenience stores as well. So, we're pretty bullish on the drugstore sector in general. But even in that sector, I mean, look, there's two strong players, Walgreens and CVS, and Rite Aid is kind of a third tier player with more risk. Some people think they'll get dived up and bought by one of the two others and split up. There's questions about how they survive as an ongoing entity, but they certainly have some strong locations and some weak locations, but, much more real estate focused as a buyer in at least the Rite Aid properties than I would be, CVS and Walgreens.
So I want to talk about, before we go into the whole what happened during COVID and after, and now what we're looking at, I have a last question about this. If I have a tenant, but it's not a national, let's say it's a franchisee, okay? It's a private guy. It could be a beautiful big name. It's nice. How, if it's not a public company and I can't open up, the regular Yahoo Finance and start digging in, how do I check it out?
So look, there's a lot of QSRs that trade, and a lot of them are franchisee. Anything from regional brands like Culver's to national brands like KFC, Burger King, Wendy's, etc., Taco Bell. Right. Even more important than the tenant's financials of the small players is their actual store sales. Because if you have strong store sales on a rent to sales basis and an absolute basis, that even if the franchisee doesn't do well at some of their other locations and is financially challenged and in bankruptcy, etc., you can be confident that they keep this location open because it comes down to individual store performance. And in bankruptcy court, where you have the option of letting go some stores, you can feel confident, despite the financials of the parent, that your individual store is a performer and thus will be renewed. So I would look at store performance first. But B, most tenants are required to A, report store sales, and B, give you some of their financials. You may not get it immediately in your due diligence, but you typically will get it, or you should get it. If you don't, obviously that causes a much greater concern because you have to speculate on what the financials are. And you probably didn't get into this business to be speculating on someone's financials. So again, I think you really need to focus on the individual store sales first, and then you kind of need to iron out the franchisee risk. And, in general, I think it's better to start with franchisees who are 15 or 20 units or more. Obviously, 1 to 5 unit franchisee are really just a different version of mom and pop with a different brand.
Right.
Exactly. So it's certainly better to have some brand versus no brand, but you're back to buying a mom and pop, and you need to just make sure that A, the store performs, and B, you're getting compensated for that risk, because you're certainly not buying, a major player.
Tell me something. When you buy that kind of player, right? When you go and you look at that, and you actually look at the financials, like you say, and that's the last question about this. How far back do you look at? Like in multifamily, we look at T12. What would you do?
You look at 3-year history, and you
3 year back. Okay.
You want to A, normalize it, and B, kind of look at the trend. You want to just look and make sure and make sure that it's the right trend. I mean, what happens 3 years isn't that material, but if it's if you're down 10% 3 years in a row, there's something wrong with the business, and you need to figure out what it is, and the additional risks that you're taking. So, but again, for store sales though, even though you get 3 years of store sales, different than the financials, you still got to look at the trend as well. Meaning, is this area or competition? What has changed? You need to figure out what the issue is.
Okay, cool. Okay, let's shift gears a little bit. We know what happened to the world a couple of months ago. It's already been actually a year ago. Can you believe that? It's unbelievable. So a year ago, the world went upside down on us. And what happened to you guys? Meaning you see deals and you have a plan for 2020 and everything's going okay. And boom, this pandemic hit. How did it affect you? Meaning you guys in terms of your world of net leases? If you could tell us about that a little bit.
Yeah, so the first quarter of last year was extremely strong. I mean, if people remember back, pre-March, January.
Sounds like another century, but okay.
Yes, but January and February were very strong last year, And, the consensus opinion was that this problem was kind of isolated to a few areas of the world and maybe not necessarily going to be impacting the United States to the extent that it did. So it started out very strong. In the second quarter, obviously March was kind of the terrible month when it arrived in full. People closed deals that were started in January and February. So the first quarter ended very strong last year. The second quarter, everyone froze because no one kind of has a pandemic playbook or understood what the impacts were going to be. So the path to least resistance was to start no new deals. No one understood what things should trade at. Lenders froze, buyers froze, sellers didn't want to take discounts. So Q2, volume was down 30 to 40%. Very small market.
Wow.
People that needed to sell, people just didn't understand what the pricing should be and what risk they were taking as a buyer. And no one knew if they had to raise money and what tenants were going to stop paying. I mean, there was just tons of uncertainty in the air. By Q3, people understood kind of what we were dealing with and, that it was going to take a while to resolve and kind of, start to get their feet back in. But when they got their feet back in, they decided, look, we're going to be kind of risk adverse and we're going to go after, tenants that are deemed essential, tenants that are open, tenants that are performing well. Again, drugstores, grocery stores, drive-through locations, investment grade tenants, long-term leases. I'm happy to get back in the market. I'm not going to take any risk. And, we're certainly not going to be buying a health club or a movie theater and things which we don't even understand the future, maybe even today of. Those things just fell out of favor. The market bifurcated. People were back, paying premiums for certain things, a McDonald's or a Chick-fil-A drive-through. People thought that this is a great thing to own during the pandemic and afterwards. So that market continued on again. So the third quarter kind of pulled it out. By the fourth quarter, people said, okay, I'm only buying, the best stuff, but I'm happy to buy it. This is what's out there. And, people went very strong. Fourth quarter finished very strong. Volumes were great. It was, if you had anything that was on the right side of things of the investment grade essential, you did extremely well. This year, the theme is still playing on, look, the best stuff is still trading and stuff like health clubs and movie theaters. People still don't understand what it looks like post-COVID, meaning how many people go back to the gym, how many movie theaters have to reopen, do people's habits stay the same? So there's just a lot of people sorting out, but they're saying, better wait and see, if 20% less people go to the gym, this gym can't afford this rent, maybe I don't want to take the risk on it. So people are playing wait and see with that. And, you're just seeing less volume this year because a lot of people don't want to sell because they don't understand where they're going to go with the proceeds. So, people are going to hold on that. And B, there wasn't a lot of new development started last year. So, for a lot of reasons, I think you're going to see a down volume year, even though cap rates are going to probably stay the same, just a down volume year because there's just a lack of things driving it. I think people really want to see COVID come to an end, not talk about come to an end. So we'll see how the vaccine distribution goes.
Tell me about that.
And we'll see how the vaccine distribution goes, and we'll see how people's habits return. And I think once we see that and the timing of that, the market will be robust after that. But I think a lot of people are still playing wait and see because, a lot of people think with the different variants and other things that this could go on longer than they want it to.
Right. You know what's interesting? If I own a movie,
clearly the ones which companies are still solvent. They have leases, they're paying the rent until they file for bankruptcy and disclaim your lease. So you're still collecting the rent from the movie chain company. The ones that don't make it, obviously there's not a lot of good reuses for movie theaters. So, they're going to be scraped and people are going to look at land values for them. Luckily, there's a lot of density in a lot of movie theater locations. And as long as zoning is okay, these are large parcels of land which allow large, multifamily and other developments, assuming they can get rezoned. And, I think they're good value plays from a real estate perspective, certain ones of them. But again, I think you need to understand if your tenant is viable or not after this. And I think with certain companies like AMC, why they haven't filed for bankruptcy and why they're still solvent, you're still collecting the rent and you don't have a problem, even though they may not be operating today yet or operating near capacity.
Okay, so going forward, where do you think we're going? Okay, everything happened, fine. We're looking at the future. As you said, people want to talk about what is actually, not talk about the pandemic over, but actually having the pandemic over. What are we looking at going forward? What type of market?
I think the pandemic only just really what it was is an accelerator of what was going to happen anyway. So I think certain companies with bad business models, JCPenney, instead of taking several years to run into troubles, it accelerated.
Right.
And certain companies that have to downsize, things accelerated. And certain categories which had troubles, sporting goods, had to shrink their business model. So again, I think these things were going to happen anyway, and Amazon was going to gain market share. But instead of happening over a 3 to 5 year time, it happened over a 3 to 5 month time. So we kind of got what we were going to get, and we just got there a lot sooner. So, in my mind, that's good news, because if it was going to happen anyway, better to just rip off the Band-Aid and take the pain now and kind of move on. So that's why bad for some, probably good for the market as a whole. But overall, this freestanding market and net lease specifically has a really bullish case for a few reasons. One, there is a aging demographic looking for fixed income. And in a world of a low bond yield and other alternatives, net lease looks to a lot of people like a way to, instead of get a 1% yield on a 10-year treasury, to up a 5 to 7% on a net lease via a REIT or whatever vehicle or direct investment. So it's a yield pickup. So I think as long as you have a large baby boom generation looking for retirement, looking for income, it bodes positive. Again, net lease is the bonds of real estate, and I think so that yield will continue to be in favor. So I think that's a positive trend. The real other great trend for this is that freestanding properties kind of held up during this time. And so I think you're going to see, things with drive-throughs. I think any tenant that's in a fast food tenant or any restaurant that is in a strip center or a mall, they're going to want a freestanding property. They're going to want the visibility. They're going to want a drive-through. And again, the drive-through is not just for customers; it's also for delivery services, DoorDash, etc., to come pick it up. So again, I think drive-throughs are everybody's going to want their drive-through. And
You're going to pick up.
Yep. And then B, I think that a lot of these enclosed malls that are having trouble with their anchor tenants and other things, their movie theaters are now closing. The case is kind of getting worse for these huge enclosed malls. I think what you're going to find is the best tenants in these malls move out to freestanding locations. So I think you're going to see Apple move out, have their own store, don't need to be part of the mall. Lululemon, same thing. So, the 10 or 15 best tenants in traditional malls are going to go out, have their own stores, have freestanding locations. People like it. It's quicker to go to. It's more visibility, and people aren't spending time at the mall like they used to. So I think a lot of these tenants all want to go out, be on their own, be freestanding. And I think so, all these malls that are in trouble, maybe half the tenants don't make it, but the good ones, they're all going to want freestanding locations, and all be new parts of the net lease market. Again, Apple and Lululemon, just to use examples, are kind of there now. They have some freestanding locations. I see a future where they could have all freestanding locations. So that's the bullish case for net lease.
Right. Let's defer a little bit. Meaning, I want to go a little bit to a place that you're actually not so much in, and that's the place of where the malls are. Okay, because it's somewhat related to what you do. You're in the retail business. Let me ask you this: in the retail, obviously, real estate business, what is the future of those things? So many white elephants out there. What's going to happen?
Well, look, I think the retail industry, the perfect business model people have found is omni-channel, which means if it's omni-channel, certainly online is taking a share of your business. And certainly if you're a big box retailer, call it Bed Bath & Beyond, the advantages of the big box was that you had everything and you had this amazing selection, and there was a reason to be at the store and get every last thing. Now,
and also have those online platforms, meaning in addition to
and now, of course, there's an online platform. But my point is, I think the store is going to be more about convenience and about best-selling items, and some unique and obscure items. People don't necessarily need the store for. Maybe they move some of that business online. So I think you're going to see a lot of big box footprints shrink because I think people want the convenience of it. They're going to look to lower the real estate cost, and people don't want to walk in the last second and get the best-selling items. But some obscure items, they can get that online. That's okay a little bit later. So I think everyone's kind of balancing, how they work out, what's convenient, what's quick for them, what's on the people's way home. You have to make yourself better than internet only, right? Otherwise, people will go internet only. Yes, there's an experience part of it, but I'm saying from the convenience part of it, there's a reason to it as well. But look, the bottom line is you're going to see omni-channel model, I think people realize some of the negatives that people don't talk about of, internet only are returns. A lot of people, order the thing, comes in the wrong size, or they have to order 2 parts, and then they're returning and they have to take it to the store. So you end up maybe not saving any time by ordering things online versus, going quickly, trying on to make sure you have the right size and have it. Plus, you don't have some of the immediate availability, which is I'll stop on the way home, I'll get it, and I'll use it tonight, or I'll wear it tonight, whatever the case may be. So, obviously, omni-channel is the winner at the end of the day, and there's going to be some winners and some losers. Again, I think a lot of prototypes are going to change, but again, I think, and some, like I said, people are going to move from enclosed malls to freestanding locations, so that's going to change as well. And some of these businesses, had problems before the internet existed, which is the U.S. on a per square foot basis has more retail than anywhere else in the world. And so that was a trend that retail was going to come down over time anyway. And again, now it's being expedited between COVID and between, e-commerce. The U.S. is going to have less retail square footage going forward. I don't think it's going to be dramatic, but it's certainly going to be less than it is today.
Well, a lot of things are happening. A lot of things are happening in the world. Tell me something, just for the sake of interest. We're always on Thursdays. People are a little, even though they love what we do, we all love what we do. We're going for the weekend. We're a little bit tired, as we call it. We want some inspirational stuff. You have a cool story. You have 30 years of experience. If you can pull out one of those experiences that you had, some crazy deal that you were involved in, something really unique that you want to tell us.
I don't know if there's a unique deal necessarily. Again, net lease deals are more
situation.
Are less unique than like multifamily with certain character owners and certain things that you found in due diligence. I mean, they're more cookie cutters, so maybe not that story. But I know it's Thursday, so you want to go back. We'll go back to my history for a second. I'll deep dive on kind of how I started and then talk about other people's career paths. Maybe that's a better thing to do than a unique deal. So
yes.
Again, graduate college, which is 1991 now, dating myself. Went to work for a firm. We were tenant rep for AT&T. So their AT&T has a variety of garages in the Midwest, 258 of them, that I was responsible for, which is where the service trucks, the repair trucks go at the end of the night and kind of where they start from at the end of the day. So this was their real estate portfolio. We were an outsourced service provider for them. And, as part of optimizing this portfolio, they were all, kind of these unique single tenant industrial buildings, which, really was just a few thousand square foot building. And then, a variety of vans parked out the back to, fix the wires or the cables or install phone systems or cable, what have you, in people's houses. That was what the portfolio looked like. And so when we were trying to buy these, meaning AT&T was trying to buy them from the actual owners of the properties, to do new to build to suits, to relocate, to do a variety of things. They wanted to, buy some of their old facilities. These people who had owned them since the 50s and 60s, were reluctant to sell them because they didn't understand, they loved having the phone company, which is what they called it at the time, as a tenant, and they didn't want to pay these huge capital gains because they owned these properties for nothing, had depreciated them all the way down. And, look, we can't sell because we're not going to pay this huge capital gain. So we appreciate the offer, but no thanks. And I said, well, hold on a minute. Do you know about 1031 exchanges? And, we can find your replacement property with a brand new property, a brand new lease. It's triple net, not double net like you have now. You go from, industrial to retail. Would you consider doing this? And so they're like, oh, sure, we'll do that. And so then we ended up buying a bunch of the properties, and in the condition that I would help these people. It wasn't even my job. I was just doing it as a service so we could actually buy the property. And after doing that for a while, for, tens of locations, I'm like, hold on, there's a decent sized market here that no one's really focused on. There wasn't a net lease market at the time. There was just properties that were single tenant. It was not a developed industry like it is today. And, started my own company by 1997. And, obviously started with that client base that was in place and the need that was in place, which was, these AT&T landlords who I still had relationships with. I kept calling on the same people and doing the same transactions, moving them into, Walgreens, or at the time it was like Kmart and Sears and other big box tenants, which were investment grade at the time. move them into other locations and kind of, had a business for 3 years, just helping my existing clients that I already had, moving from that to that. And, I just stuck to my knitting. I believe that, look, I need to be either a small niche focused firm or a large national player. I didn't want to be kind of stuck in between, a little bit of a specialty of anywhere, but not known for anything. So I'm like, look, we're going to stay small. We're only going to do one thing. We're going to turn down all other business, including, strip centers and 3 tenants and anything else, even if it's in retail and investment. We're not going to do it. We're just going to do one thing, which, kind of hurt me at the time. People don't like to pass up deals and move on. But, we've kind of stuck with it year in, year out. And, as of last year, we ended up in one of the top 10 firms in the country, despite being a boutique that does just net lease investment sales. So, it's a business model that works, and we're kind of running it year in, year out. And, after 30 years, you get fortunate enough to have repeat clients, and it turns into a really good business. So, for the people who are starting out there, which I know is some of your audience, my thing will tell you is, to find a specialty, become known in your specialty, and be laser focused on it year in, year out, become an expert in it, an authority. And again, it may take a few years. There is no shortcuts in this business.
No shortcuts.
But it will pay out over time, because other people in your office and other people that are going to switch firms. They're going to switch, specialties. They're going to switch a variety of things. And, it's very difficult to get ahead when you keep restarting from scratch and going back to go every time. So, again, I hate to say it, but grind it out works. And it will pay off for you over time doing the right thing.
Right. Got to stick to it. Got to grind it. Right. Exactly. What's the difference between starting out in your days and today? If you have a new broker coming into your firm, what is the difference? You see them starting and you see you starting then. What is the difference?
Well, it's night and day. And I'm certainly going to age myself because, when I started in 1991, it was for the most part pre-internet. And so the technology changes I've seen, almost pre-cell phone, the technology changes I've seen in the last 30 years have been amazing. So it's a completely different business than it was back then. There wasn't Instagram, there wasn't podcast, there wasn't LoopNet and CoStar. There was, all kinds of different things. You had, a lot more things are done for you today. But again, a lot of things which you can claim competitive advantages are taken away because everyone has access to them. Obviously it's what you do with them, meaning, some people can turn podcasts into something, see SharkEye, and some people can't. Same technology, right? But, it becomes on what you've done. So it's a completely different business than it was today. Again, I think that it's best to start out with, I still think starting out with the people you consider to be mentors and someone who can teach you the business is better than kind of some kind of system, which may or may not work. Big firms have pros and cons, but I don't think they're great at taking a lot of people under their wing because of the way they're set up. I think boutiques do a better job at that. Again, big firms do a lot of.
Can you explain that a little bit? Can you
Well, again, I think
that's important for people to understand.
At these bigger firms, a lot of them, they hire 30 people in an effort to keep 5 to 10. I don't think that's very sincere or authentic. I think if you go to a smaller firm, we hire one to keep one, and we're going to make sure that one person works because otherwise it looks like a failure on us. Big firms have 60% attrition built into their model over 5 years.
Crazy turnovers sometimes. Yes,
crazy turnover. I don't know how that's good for business. Again, people don't want to spend the time and effort on you because they don't know if you're part of that 60% or part of the 40% that stays. So it's kind of a business built on attrition, a business built on churn, a business with fewer people at the top. Again, I think it may be a place to excel. If you're focused on national accounts and Fortune 500 companies, obviously you have to be at one of these national firms. So again, ends up what you're focused on being. But again, if you're focused on private investors and high net worth people and family offices, I don't see there's competitive advantages of a national firm versus a smaller firm. And again, I think you'll get more individual attention because again, at a small firm, it's much more important that you succeed. They've invested in you, whereas large firms are playing numbers just because they have to by the size of the firm.
Listen, this is really interesting, and you definitely have vast experience in this business. And tell us a little bit about how can people reach out to you if they're interested, they want to invest, they want to get into this world, they want to work in this world, they they want to buy property, a net lease property, how can they reach you guys?
The best way to find us is our website, bouldergroup.com. There's a contact page with all of our information. Certainly, you can look me up at any of the platforms. LinkedIn is probably the easiest for Randy Blankstein. But again, I started a website. You can reach out to me at anybody that works here. We're all kind of a team. Again, boutique firm. Again, you can find us on LinkedIn. Those are probably the two best ways to find us. But we're on Twitter.
And you guys deal with cross country, right? With all over.
We're based in Chicago, but it's a national business for the most part. 68% of net lease properties. I apologize for that.
It's a deal. It's a deal.
68. It's actually an intercom for someone downstairs. 68% of net lease properties are owned by someone who's not in the state of which they buy them. Again, no matter where you are, again, since there's no active management, it doesn't make a difference if you're in a Walgreens in Florida or California. All you're really doing is, at the end of the day, collecting the check or the wire at this point. So, it's very easy to own properties throughout the country. And again, most of them are owned in states which you're not in. And it's very much a national business because it's not based on individual markets. It's based on tenants. So it's unique. It's unique in the commercial real estate field in that way. Some major strip centers are set up that way as well, but they involve, getting an asset manager and a property manager, which you don't really need to do for net lease for the most part.
Right. Randy, it's really been interesting. I really thank you for this. Really thank you for your time. If you could stick around, I'm going to wrap up the show. If you could stick around for a couple of seconds, I'm going to speak to you right after. But really, thank you very much for being with us. It's been really interesting. And it was an honor to have someone who has been so many years in the business, has so much knowledge of the net lease sector. And I wish you we wish you success to you and your firm. And we'll meet again. Maybe we'll do something together also. So
absolutely, you as well. I appreciate you having me on SharkEye. It's exciting. I listened to your podcast for a while, and
thank you.
Happy to be here. It's a great show, and hopefully it continues to be a great show with great guests in the future.
Okay, great. So stick around. I'm going to talk to you in a second. I'm just going to wrap up things. So guys, I hope you guys enjoyed this show. For those who listen to us live, it was a little bit glitches here and there. I'm going to on YouTube, I'm going to fix a little bit of the glitches so you guys can hear it all straight and all clean and great. And same thing I'm going to do for the podcast as well. Anyways, you guys, just want to remind you about the 7-day challenge that you can find right here, whether it's below, up, in the bottom, wherever you are, wherever you're watching it. So you can join it and get to know commercial real estate. If you want to know more about the Boulder Group and Randy, you can actually check the links. They're all over the place here. You can actually get there and actually contact Randy directly if you're interested. And what I can tell you is have the most beautiful weekend. Enjoy your weekend, guys. Rest up because on Monday, we're back again. We're back in action. So take care of yourselves, and I'll see you guys later.